Hi all, hope you people are doing great. So yes, now we are starting with revision of dissolution of partnership including a piecemeal distribution. Okay, so far we have done a revision of admission, retirement, death of a partner as well as a JLP adjustment. So now we are going to start with revision of dissolution of a partnership firm including a piecemeal distribution. Okay, so what do you mean by dissolution of a partnership firm? Dissolution of partnership firm is nothing but closure of a partnership business. Dissolution of partnership is nothing but the closure of partnership business. So when we close the partnership firm, when we close the firm, what are the transaction or what are the things we have to do? That we are going to learn in this particular unit, that is dissolution. Okay. So see, whenever a reconstitution takes place within a partnership in form of admission, retirement, death, etc., then the firm will not get dissolved. The partnership will get dissolved, which means the agreement among the partners, the relationship between the partners will get dissolved, not the partnership firm. But when you close the whole business, then your whole partnership firm will get dissolved. Okay, that we are going to learn now. Dissolution of partnership we have already learnt in admission, retirement, death, where business will continue, only the relationship between partners will change. Okay, so there might be lot of reasons for the dissolution of the firm. Some among them were by mutual consent of all the partners. Okay, mutual consent of all the partners might decide, boss, done, we are done with the business, no need to continue. That might be the one, like mutual consent. That is, and giving a notice to all. One guy giving a notice, one among the partners giving a notice to everyone, telling that let's close the business. That might be one way. And on happening of any of the following event, one is expiry of a term with the partnership. That is, we might have we might have done an agreement telling that our partnership will continue for next 5 years. So after completion of 5 years, automatically business will come to an end. Or completion of the adventure, we might have thought, okay, we are going to do this particular business. Once that particular thing is done, we are going to wind up our business, or we are going to dissolve our partnership firm. Death of a partner, if there are only two partners, one partner died, which means partnership definition itself says persons, which means two persons are needed at least, right? So out of two, one died means only one will be there. He cannot run a partnership business, right? Yes. Next one is adjudicating of a partner as an insolvent. Let us assume two partners were there. One partner is adjudicated as an insolvent, which means the other person cannot run the partnership business. Even the guy who became an insolvent for certain years, as per the court's order, he cannot also be a partner in a partnership firm. Not only the partnership firm, he is restricted from entering into business, because he already entered into business, he had become an insolvent, which means he already put so many caps for the people, right? Yeah, 3 namas. So again, court will not allow him to do the same thing again soon. So they will restrict him from being a partner. Him means her also included. Okay. And there might be a compulsory dissolution. Okay, they are where all the partners are all but one are adjudged insolvent. So all the partners become insolvent, or except one, all partners will become insolvent. Then one person can't run a partnership firm for sure. Okay. Next, if any event occurs making it unlawful for the business of the firm to be carried on. If you are running some illegal business, if they allow you to run the business again, you do the same thing, no? That time also they will close your partnership firm. Dissolution by court. So court might ask you to stop. When, sir? Insanity of a partner, that is one of your partner gone crazy. Permanent incapability of a partner to do his duties. So when one among your partners becomes permanent incapable of doing the transaction, then also your partnership will get dissolved. If a partner is guilty of misconduct that might affect prejudicially the carrying on the business. If some of your partner had done a mistake and he might go to jail, or he might end up being something where it will affect your business, then also the court will ask you to stop the business. If a partner willfully or persistently commits a breach of contract, breach of agreement. So your partner is willfully breaching the agreement or continuously breaching the agreement. And if the court considers that business cannot be carried except for a loss, you will be enthused. Okay, we will get our business into profit. If not today, tomorrow, like that. But still, if court feels that okay, you are in the business, such a business that you are never going to earn the profit, then court might ask you, boss, stop it, do something else. Okay, that might be one of the reason. On any other ground on which the court considered dissolution is just and equitable. Okay. Settlement of dissolution, settlement on accounts of dissolution, simple. If loss is there, who has to bring? The partners has to bring, because partnership is unlimited. Partnership liability is unlimited. Okay. So what we are going to do is, in an accounting point of view, when the dissolution happens, all the assets we are going to transfer it to some special account called realization account. All the assets are transferred into some special account called realization account. All the asset excluding your cash, bank and your fictitious assets. I repeat, cash, bank and fictitious assets. And we are going to transfer all the liabilities, outsiders liability, into realization account. We are going to transfer all the outsiders liability into realization account. And later we will pay using that account, and at the end of the day, whatever balance remains, either it might be loss on realization or either it might be gain on realization, it should be borne by the partners. It should be borne by the partners or shared by the partners if it's a profit on realization, but hardly there will be a profit on realization. Okay. What are the steps involved? First, you have to prepare a realization account. You should transfer all your assets and all your liabilities. Okay. So when you transfer your assets into the realization account, what will be the entry? When you transfer your assets into the realization account, your assets will be showing a debit balance. Now you are going to credit them, debit the realization account, the special account, the nominal account. So the entry will be realization account debit to asset account. But here you should make sure that you are not going to transfer cash, you are not going to transfer bank, you are not going to transfer fictitious asset. At the same point of time, one more tricky thing is there here. Listen, your balance sheet might be showing something like this: debtors 1 lakh rupees, provision for doubtful debt 10,000 rupees, net debtors 90,000 rupees. I repeat, debtors 1 lakh rupees, provision for doubtful debt 10,000 rupees, net debtors 90,000 rupees. You should not transfer debtors 90,000 rupees, that is net debtors 90,000 rupees. You should not pass the entry telling that realization account debit 90,000 rupees to debtors 90,000 rupees. Wrong. Why, sir? Because debtor might be your asset. Debtor might be your asset, but provision for doubtful debt or provision for bad debt is your liability. So what you should do is, the debtor, the gross debtor, which is your asset, that you have to pass first. That is realization account debit to debtor. The PDD is there, no? That is provision for doubtful debt or provision for bad debt, that you have to transfer along with the liabilities. What will be the entry? Liability will be showing credit balance, now you debit it. So what will be the entry? Liability account debit to realization, of course PDD account debit to realization. Okay. Now when you sell these assets, the assets which you took into the realization, when you sell this asset, and one more point is, if your balance sheet is showing a goodwill, then take that goodwill also to the realization account. Okay. I repeat, if your balance sheet is showing a goodwill, you cannot create a goodwill on your own, right? AS 26. But if your balance sheet is showing a goodwill, that might be arised out of purchase or something. So purchase of goodwill, you can show it in the balance sheet. So if that's the case, you are supposed to transfer even goodwill along with the other assets. Okay. So when you sell these assets, either you can sell it for cash or bank. So what will be the entry? cash or bank account debit to realization account, because assets are already transferred into the realization. Assets are already transferred into the realization. Debit, for the debit balance we have given them a credit, which means now asset accounts are showing 0, 0, 0, 0. Now you can't credit them again, right? If you credit them again, what happens? It will start showing a balance. So do not do that. You should not do that. You have to give a credit to the realization account, because for asset transfer you have given realization account debit. Now what will be the entry? If you sell it for a bank, I mean cash or bank, entry will be cash or bank account debit to realization account. What about you have one asset where our partner is interested in that? You have one asset, our partner is interested in that. For example, your business is having some Royal Enfield bike. One of our partner loves that bike, so he want to take and go. Let him take and go. Let him take and go. So what will be the entry at that point of time? Of course, your partner's capital, you are going to withhold that money from your partner's capital, right? So for you, cash or bank will not come. So what happens? Partner's capital account debit, because decrease in his capital balance, to realization account. Realization account. Next comes all the external liabilities you are going to transfer it to the realization account, right? So what will be the entry? Liabilities account debit, because they will be showing a credit balance. Now you have to debit them to the realization account. Okay. Later you are going to pay them. Later you are going to pay them off. So what will be the entry? Realization account debit to bank account. To bank account or to cash account. Okay. Sir, what if one of our partner assumes a liability? What if one of our partner assumes a liability? In that case, realization account debit to partner's capital account, because although he takes your liability, you are liable to pay him back. Although he is repaying the firm's liability, firm is liable to repay him back. So his capital balance will get increased. So what will be the entry? Realization account debit to capital account, to partner's capital account. And to do all these things, you might incur certain expenditures, which is called as realization expenditure. So when you incur that, what will be the entry? Of course, normal expenditure, but later you have to transfer it to the realization. For example, expense account debit to bank. Later you have to transfer it to the realization account. So entry will be realization account debit, as it's expenditure, nominal account debit to realization expense. Whereas realization expense gets cancelled, debit and credit. So final entry will be what? Final entry will be realization account debit to bank account. Realization account debit to bank account. Okay. So realization account debit to bank account. One more thing is there in the realization. That is, one of your partner might say that, boss, I am going to look after the realization. You pay me 5,000, 10,000, 20,000 like that. He might ask the firm. To pay the certain money towards a realization where he will be looking after the realization. Then listen carefully. Whatever the realization expense happens, that should be borne by the partner. Whatever the realization expense happens, that should be borne by the partner. Okay. So if you have given a liability, or if you have given a responsibility of realization activity to your partner by paying certain money, when you pay him certain money, what entry will pass? Partner's capital account debit to bank account, right? Or you might give him a credit, realization account debit to partner's capital account also, you never know. So realization account debit to partner's capital account also you might give. So what happens is, when he takes over all the realization activities, if any realization expense arises, that should be borne by him. You should not pay. You should not pass the one more entry telling that realization to bank. If that's the case, why you have given it to your partner, right? So when you have assigned it to him, when you paid money to him, let him look after the expenses. In firm book, realization expense will not come. Okay. What if certain unrecorded assets are sold, sir? What if certain unrecorded assets are sold? Unrecorded asset, that wasn't an asset till now, but at the time of dissolution we came to know that there was an asset. So what will be the entry? bank account debit to that particular realization account, right? Realization account, because asset account you can't credit now because debit is not there. How you can credit? So bank account debit to realization account. If there is a unrecorded liability, there is certain liability which is unrecorded. Now how you are going to do that? Simple entry will be realization account debit to bank account. If partner takes over, instead of bank account, their partner's account, partner's names will come. Okay. Later whatever might remain, if realization shows the debit balance, which means it's a loss, you have to recover it from the partners. So what will be the entry? Partners capital account debit in their profit sharing ratio, okay, to realization account. If realization account shows a credit balance, which means it's a gain on realization, then you have to give credit to your partners. So what will be the entry? Realization account debit to partners capital account in their profit sharing ratio. Sir, what if there is some loan of the partner, which means partner has given you a loan, that is not an external loan. Partner's spouse loan is an external loan. Partner's loan is not an external loan. So if partner spouse loan is there, just add it like outsider's liability only, okay? Don't use your brains much. It will go to only one house and all. No. So if partner's loan is there, that you directly settle it through bank account. What will be the entry? Partner's loan account debit to bank account. Partner's loan account debit to bank account. So what we should do is, if we are maintaining a partner's capital under a fixed method, what we should do is, partner's current account balance we should transfer it to the partner's capital account. If the current account is showing a credit balance, partner's current account debit to partner's capital account. If our partner's current account is showing a debit balance, which means he has to pay us, we are going to reduce it from his capital. So partner's capital account debit to partner's current account. Okay. If there is any reserves, or a funds, then what you should do? Reserves or a fund, you should give it to the partners, like our admission retirement. Okay. So fund or reserve account debit to partner's capital account. Against that fund, if there is any liability, first we have to adjust that liability. Okay. Against that fund, if there is any money which should be payable, take out that money and net amount you should allocate it to the partners. Done. So much is relating to normal dissolution. Okay. Now comes insolvency of partner. That is, one of your partner in the firm is insolvent. When he becomes insolvent, the partners who are having money, right? They should compensate this partner. I mean the partners who are solvent, basically. The partner who are solvent, they should compensate the insolvent partner. Okay, fine. So to do this insolvency, to do this kind of accounting and all, there is one case called Garner versus Murray. That's what we are going to apply in case where one partner is insolvent, or one partner or two partner might be insolvent. Okay, where the partner is insolvent, you can say in simple. Okay, what we should do is simple. Garner versus Murray, you can say two. One fixed capital, the other one is fluctuating capital. Okay, first what you should do is, you should do the realization account just like a normal. You should do it as a normal. Okay sir, we did. Let us assume you got a realization loss. If you got a realization gain, fine, keep it aside. But assume that you got a realization loss. Now, as per Garner versus Murray, you should bring a money towards a realization loss. The partner who are solvent should bring the money inside the firm which is equal to realization loss. For example, there are three partners. A, B and C. A, B and C. Realization loss is there. A 5,000, B 3,000, C 2,000. Let us assume C is a insolvent. C is a insolvent. Okay. Now A and B are there. No, A and B. First they should bring a money towards loss on realization. That is entry you should pass bank account debit to partners capital account. Who are the partners? A and B. Bank account debit to A's capital account to B's capital account 5,000 3,000. 5,000 3,000. After all the things, after all the adjustments, A and B who are solvent partners should pay C's money. C whatever have to pay to the firm, no, A and B should compensate that. In between C's estate might give you some money. For example, C's estate might give you 50,000, 60,000. That is the maximum you can recover. That time one entry will come. Bank account debit to C's capital account. Okay, bank account debit to C's capital account. After doing all the transactions, after doing all the entries, C might show a debit balance. If it's a credit balance, Y will become insolvent, right? So, C might show a debit balance. C will show a debit balance. That is, our insolvent partner will show a debit balance. That debit balance should be bared by our solvent partners in which ratio, sir? Capital ratio. As per the Garner versus Murray, first what we should do, solvent partners should bring money towards their share of loss on realization. Solvent partners, only solvent partners, don't give debit to even insolvent partner because he is not having money. Okay, so only solvent partners should bring their share, okay, don't bring even insolvent's share, don't use brains much. So only solvent partners should bring money. Okay, so when after they bringing a money, after doing all the adjustments, insolvent partners share will be there, no, that insolvent partners loss to overall how much he has to pay to the firm, that should be borne by solvent partners in their capital ratio. Now sir, how to arrive at a capital ratio? If it's a fixed, if the capital is fixed, no, then the same whatever the ratio is there in the fixed capital account, that only you take. But if it's a fluctuating, except the realization loss or gain, whatever the transaction will come, no, whatever adjustments will be there, general reserves, funds, accumulated profit, accumulated losses, whatever might be there, except realization, first adjust everything to the capital account, except realization, before realization expense adjustment, what the capital will be there, no, in that ratio you have to bring the deficiency of insolvent partner. Okay, in that ratio you have to bring, I repeat, adjust everything other than the realization, adjust everything other than the realization, and in that ratio, after that you will get certain capital. In that capital ratio you have to bond the liability of our insolvent partner. Okay, so that is all about Garner versus Murray. Next one is piecemeal distribution. Listen, till now what we thought was, we will bring every asset into the realization account, we will bring every liability into realization account. In a wholesale we will sell the assets, in a wholesale we will pay the liability. No, practically that is not what happens. That is not how it takes place. Slowly we will start selling your assets one by one, batch wise, or whenever you get offers. Of course you might sell it together also if someone purchases the business directly. Okay, but yeah, very high possibility where slowly asset one after the other it starts realizing. So as you start getting a money in a step different times, you are not getting it in a one time, you are getting it in a different time span, right? So as you start getting a money, you will start making a payment towards your liabilities, later start making a payment towards your capital. That is called piecemeal distribution. That is, out of whatever meal you will get, you will keep piecing it. That's it. Okay. So the order of payment will be what? First is realization expense. The first payment what you should make is realization expense. Whatever the money you receive, whatever the stage it might be, if there is any realization expense, you have to pay it first. Second, if there is any provision to be created, create it. Third, your preferential creditors, that is your government, taxation, all those things, income tax department, GST, all those people. Next one is secured creditors. Secured creditors only to the portion of secured, only to the portion of realization of secured assets. For example, one of the secured creditor who gave us goods of 10 lakh rupees, okay, secured through certain goods, now which we sold for 6 lakh rupees. Now that 4 lakh difference will be there, no? For that 4 lakh he will become unsecured creditors. He will be placed with unsecured creditors. So secured creditors to the extent of realization of that particular asset which you secured. Next one is unsecured creditors. Next one is partners loan, later partners capital. Later partners capital. So if you want me to repeat, first you have to pay the realization expense. If any money remains towards the expenses, the other expenses will be there, no? Some provision we have kept, that things. If money remains, secured creditors, preferential creditors, that is your government, etc. If money remains, secured creditors. If money remains, unsecured creditors. If money remains, partners loan. If money remains, at the end, partners capital. At the end, partners capital. Okay. Okay. Let us assume everything is paid. Let us assume everything is paid, but except partners capital, there is certain money which is available to pay them. Okay. There is certain money which is available to pay them. Now they thought, okay boss, we'll divide it in our profit sharing ratio. We'll divide it in our profit sharing ratio. But one partner said, listen, you people know, have gave base capital. For example, if 2:1:1, you people, for example, A, B and C sharing profit and loss in the ratio of 2:1:1. B and C thought, let's take and go the money which is available after all the payments, whatever money is available, no, that we will take and go in the partners profit sharing ratio. So these people have put a capital of 1 lakh each, but A is there, no, he contributed 3 lakh rupees. A is there, no, he contributed 3 lakh rupees. Now if they take and go, don't you think it's cheating for A? Because he paid more capital, he is having a more capital. So A said, all this drama you don't do, I have paid more money, so first I will take out my money, the excess money which I have already put, later I will come with par with you people, later we will take it in profit sharing ratio, So this conflict happens, no? That's why in piecemeal distribution we are going to ascertain capital, we are going to ascertain how much is the surplus capital. Okay, so listen, so how we should allocate it to the partners? For that we have two methods. One is called surplus capital method, also called as proportionate capital method, also called as highest relative capital method. I repeat, surplus capital method, proportional capital method, highest relative capital method. Whereas one more method is there, maximum possible loss method. First method will be applied where all the partners are solvent. That is, your surplus method will be applied where all the partners are solvent. Your second method, that is maximum possible loss method, will be applied where your all the partners are not solvent, some among them might be insolvent. Okay. Okay. Now How to do in the surplus capital method, sir? Simple. First you have to consider adjusted capital. First you have to compute adjusted capital. Adjusted capital is nothing but capital after adjustment of everything. Capital after adjustment of everything, like your current account balance, reserves, etc, etc, etc. Okay. After we compute the adjusted capital, we should divide it with the we should divide it with the profit sharing ratio. We should divide it with the profit sharing ratio. For example, adjusted capital of these people are 3 lakh, 1 lakh, 1 lakh. 3 lakh, 1 lakh, 1 lakh. Now, as this is, or let us assume 3 lakh A, 1 lakh 20,000 B, 1 lakh C. A, B and C. Okay. A, B and C. A 3 lakh, B 1 lakh 20,000, C 1 lakh. Now we will take profit sharing ratio. This is adjusted capital. Okay, this is adjusted capital. Capital after adjustment of current account, P&L, debit balance, credit balance, reserves, etc, etc, etc. So this is adjusted capital. Adjusted capital. Later what we will do is we will take profit sharing ratios. 2:1:1, right? 2:1:1. We will take now proportionate capital. Proportionate capital, or you can just say it as capital per unit. Capital per unit. See, for 2 units, A invested 3 lakh rupees. For 2 units of profit, A invested how much? 3 lakh rupees. So per unit how much he invested? He invested 1,50,000 rupees. For 1 unit, B invested 1,20,000 rupees. For C, for 1 unit, again he invested 1 lakh rupees. Now we have to take the base capital. We have to take the base capital. Base capital is nothing but lowest among all the capital per unit. Lowest among all the capital per unit. That is 1 lakh rupees. Base capital is how much, sir? Base capital is 1 lakh rupees. Now we have to find out a proportionate capital as per the base capital. After computation of the base capital, we have to find out the proportionate capital as per the base capital. Proportionate capital. So proportionate capital is, we should multiply number of units, that is PSR, into base capital. PSR into base capital. So how much it is? Here it is 2 lakh, right? Here it is 2 lakh. Here it is 1 lakh. Here it is 1 lakh. There 2 into 1 lakh comes to 2 lakh. There 1 into 1 lakh will come to 1 lakh. 1 into 1 lakh, 1 lakh. We will get a surplus now, surplus capital. We will get a surplus capital. So surplus capital is how much? In the A case, he is actually having 3 lakh rupees, but his proportionate capital must have been only 2 lakh rupees if we go as per the base capital. So he is having a surplus capital of 1 lakh rupees. B, he is having a capital of 1,20,000, but if we go as per the proportion, he should be having only 1 lakh rupees. So 20,000 is a surplus. See, as we have taken his only base period, base capital, no surplus. Now again the process will continue. Again the process will continue. Process will continue till we will get one partner surplus. I repeat, the process will continue till we get one partner surplus. So profit sharing ratio 2 and 1, right? 2 and 1. Capital per unit. Capital per unit is how much? Here 50,000, here 20,000. So which is the base? Base is of course minimum of 2. Which is minimum of 2? 20,000 is minimum of 2. So what is the proportionate capital? What is the proportionate capital? Proportionate capital is 2 into 20,000, which is 40,000, and 1 into 20,000, which is 20,000. So what is the surplus? What is the surplus capital? 10,000 and 0. 10,000 and 0. So after getting a surplus capital, what we should do is, simple. Listen. first we should give it to the whatever the money we receive now, whatever the money we receive, as we start receiving the money, first we should give it to the realization expense, later any provisions is there for that, later for the preferential creditors, later for the secured creditors, later unsecured creditors, later partners loan, and if something remains after that, what we should do is, first we should give 10,000 rupees to A. As per piecemeal distribution, first we should give 10,000 rupees to A. Okay. After giving, next payment will come. No, in next payment you should adjust 1 lakh of A and 20,000 of B. 1 lakh of A and 20,000 of B, because that is the surplus. After A and B both are having a surplus, so that surplus will be adjusted. After adjustment of surplus, if anything remains, then give it to A, B and C as per their proportionate, profit sharing ratio. Then give it to A, B and C as per their profit sharing ratio. Okay. This is how the piecemeal distribution works. Under that first method, that is surplus capital method. Second one is maximum loss method. Second method which we are going to apply is a maximum loss method. Here this is applied when one among the partners is insolvent. Not one among, certain partners are insolvent. It might be 1, 2, 3, any number of partners, provided that if there is one part, if all the partners are insolvent, no, then no one can give it, right? Except one, if all are insolvent, that one partner should bear the losses. Okay. In a maximum loss method, how we are going to do? In a maximum loss method, prepare a statement showing a distribution of cash, just like I told no, in our first method, surplus method. First pay to the expenses of the realization, provisions, preferential creditors, secured creditors, unsecured creditors, partners loan. The statement, same statement will come. Later, pay off the external liabilities. After all the payment is made for the external liabilities, the partners will be paid off. The partners will be paid off. How sir? Simple. You have to take how much due to the partners, how much balance is there in the partners capital account. Later you should take how much is the realized money right now. For example, partners are having 2 lakh, 1 lakh and minus 50,000. Let us assume we are having 2 lakh, 1 lakh and minus 50,000. Okay. Is insolvent. A, B, C is insolvent. Now let us assume we realized, so how much is the total capital here? Around 2 lakh 50, right? So now let us assume we realized 60,000. We realized 60,000, or let us, for the time being, we will keep it as 10,000, positive 10,000. So how much is payable? Payable is 3,10,000. We recovered 60,000 rupees. We received 60,000 rupees. Now what we assume is this is all we can recover. And now we will calculate the maximum loss. How much would be the maximum loss? How much would be the maximum loss? The maximum loss, how much would be the maximum loss? Out of 3,10,000, 60,000 is recovered, which means 250,000 are maximum loss. 250,000 are maximum loss. So we are going to allocate 250,000. We are going to allocate 250,000 as a maximum loss to all the partners in their profit sharing ratio. And later we will find out how much is surplus or deficit. So if there is a deficit, that will be again continued, and one insolvent partner, his deficit will be borne by the solvent partners. Insolvent partners deficit will be borne by the solvent partners, and this is how we are going to continue in each and every step. Okay, see, the maximum loss shall be shared among the partners in their profit sharing ratio as if there will be no further realization. We are going to share the loss. Okay, this is your loss, boss. So much you lost. Later again the money comes. So this much was your capital. Now so much is realized. So this might be the maximum loss. For example, here 2,60,000 was pending. No, 2,60,000 was pending. Out of 310, 250 was pending. Let us assume again we realize 70,000. Now we assume that our maximum loss is 180,000, like that. If any partner's capital after step 4 is negative, that partner shall be treated like an insolvent partner. That is, we apply a Garner and Murray and Garner versus Murray, and we are going to share it by the, it is going to be borne by the solvent partners in their capital ratio. This is repeated until the final step of realization, until the last payment is received. This step is realized, and we will, at the end of the day, we will find out how much is the maximum loss, actual maximum loss. That's it for this particular dissolution revision, where we learnt about normal dissolution, whereas after that insolvent is there, Garner versus Murray, and after that piecemeal distribution under two methods. One is surplus method, the other one is maximum loss method. I hope you enjoyed the video. If you had really enjoyed, please subscribe for that channel, because we are coming up with more and more revision videos, not only this subject, all the subjects. Okay, till the next video, bye bye.